In fact, Siddharth Khemka is also joining in. He's a head of retail research at Motilal Oswal. Siddharth, if you heard Manik, I mean, there's a potential of Infosys also cutting its guidance, perhaps, cautious commentary from the rest of the pack. As an investor in IT stocks, what do you do now?
Yeah, hi, very good morning. So I think last quarter we saw Infosys already cutting the guidance. So there is definitely some more risk after what Accenture has done and whatever the commentary is, and we heard in detail. So I think near term, we'll have a knee-jerk reaction today with the guidance cut and the expectation that the near term pain could continue in terms of demand. While the deal wins continues to remain strong, and that is something which keeps the hopes alive that things would recover maybe 1 or 2 quarters down the line. And I heard you rightly saying that some of the street was pricing in or penciling in a recovery from the 1 or 2 quarters down the line, but that could be also at risk. Having said that, valuations are comfortable and the long-term visibility is still there with the deal wins being strong. And we heard the US Fed commentary how things changed overnight with the US Fed saying that the economy is very strong, inflation would come down, and they would do the 3 rate cuts. So I think one near term, definitely there could be weakness, but there would be some recovery 1 or 2 quarters down the line, and things would start looking better. Investors who are having a long-term view, having a patience to ride through the near-term volatility, are the ones who are buying the tech stocks in this current market environment where we are seeing a lot of volatility, a lot of sector churn, and where I think IT provides that kind of safety in terms of long-term growth visibility as well as valuation comfort. So again, to cut short, near term there would be pressure, but for someone who has patience, I would buy into these corrections, as it would be good opportunity to buy into some of these good names.
Okay, all right. Hi, Sid. Morning. Good to see you. Since the globe looks to be in a bit of a tizzy, at least for the time being, particularly with regard to the tech names, let's look inward. Let's look at the domestic-facing themes. What do you like out here? You've been positive in the past on cement as well as real estate. What views out there, and which are the stocks that you would look to buy?
Yeah, Nigel. Good morning. So cement, we had been positive, but if you look at last few months, there has been a price decline, and the channel suggests that price has been coming down about 1.5-2% on a month-on-month basis in Feb as well, and largely led by regions in East, South, and North regions. The only good part is that demand has been pretty strong and healthy. The other part is that with the election code of conduct now being set in, we expect some slowdown in terms of the infrastructure offtake, while the residential demand and the real estate demand for cement continues to be pretty strong. So again, a sector where I think 1 quarter of weakness could be seen, especially in the Q1 of FY25 because of the price cut and the rising crude oil prices, which has just started rising off in the last couple of weeks. So there would be some pressure in the cement pack. Nonetheless, we like Ultratech in the large cap space, which is the well diversified player with a presence all across India and a very efficient operations. And within the mid cap space, we like JK Cement. Similarly, if you talk about the real estate pack, I think things were looking very good, and they're reporting very strong numbers, record, you can say, bookings for most of the players. And we saw a stock run up as well in the past. And in the last few days, we have seen a good profit booking. So we believe that it's a good entry opportunity into the long-term story for real estate because things have not yet slowed down. And again, the US Fed talking about 3 rate cuts, RBI will follow suit, and that will also help improve demand in the mid segment. Right now, we are seeing a lot of strong demand from the premium and the luxury segment of the real estate market. So I think that would do well. We like a Prestige and Sobha. But if you look at a Brigade Enterprises is also entering into some of the non-focus regions, which should also help boost growth.
So that very interesting note from UBS on Reliance this morning, where they have raised the target price to 34.20, and they talk about how they are really bullish on the consumer-facing businesses. Is it a good time to be putting more money to work in Reliance?
Yeah, Sonia. So incidentally, we also put out a note yesterday on Reliance. What we are looking at that the company is turning into new energy, and that vision is now looking into more action. The Ministry of New and Renewable Energy has recently announced it plans to set up 2 hydrogen hubs in India by FY26, and also to provide incentives up to 44 billion rupees for electrolyzer manufacturing. And we are seeing that what Reliance is doing is that they plan to establish a large giga-scale electrolyzer manufacturing facility, which we believe is like focusing on the new energy. And this is the same reason why the street turned a bit negative, because these are large capital-intensive business, and the company which had become net debt-free some time back got into more debt. And now we are seeing that coming in, fructifying, and a lot more focus is into the green energy. If you look at the core business, the oil and chemicals, we believe that Q4 should remain robust, given the sharp recovery in the Singapore GRMs, which currently is about $7.4 dollar per barrel, compared to Q3 of 5.5. And we believe that that should be positive. NAFTA, as well as the petchem spreads are also stable Q on Q. And in the telecom business, we are seeing a 5% CAGR for subscribers as well as ARPU. And in the overall retail business, we are expecting for the next 2-3 years almost 29-30% EBITDA CAGR, led by store additions, higher store productivity, as well as foray into digital, as well as new e-commerce businesses. So overall, I think it's a very good time to set your eyes into Reliance Industries. Market is also favoring the large caps. The valuations for Reliance is comfortable because it's not participated in the recent past. So we have a buy rating and a target price of 3,210, and definitely a very positive view on Reliance.
Okay, that's a positive call on Reliance. What is not so positive is the market's first reaction to IT, and that's a long expected line. So we started getting the pre-open rates. Let's pull up some of these stocks, HCL Tech, Wipro, Infosys, TCS. These are first reactions. Remember, this is pre-open, but the screen suggests that we could look at between a 2% to 3% dip, depending on whichever stock you're pointing out. The bigger question is whether Reliance, the stock that we were just discussing, whether RIL and the larger banks, whether they can come and pick up the tab. Right now, HDFC Bank is also nursing a bit of red, so it doesn't seem like it. We now have the first rate on the Nifty, the pre-open rate, and that's a 0.5% decline. So about 120-point cut is the kind of gap down that we can expect at open. So that's how it's playing out. Siddharth, just to wrap things up, I mean, when we started, you did mention that maybe these dips in IT could be a decent buying opportunity. So just expand on that a bit, because we were just speaking to an analyst earlier. The fear is that because of the reality that Accenture has put out there, maybe even Indian giants like Infosys will come out and scale down their FY25 guidance, and stocks have already moved higher. So despite the rally, what do you still like in IT?
Yeah, Surabhi. So I think definitely there is a risk for further downgrade in the guidance by Infi, like the likes of Infi. So what we like within the IT is TCS. We believe it's a well diversified player, largest among the Indian IT companies, with presence across the segments. And given its size, we believe that it could continue to do well despite the weakness, near-term weakness. The second set that we like is the ERD businesses within the tier 2 players, where we are not seeing the kind of slowdown these IT services companies are witnessing. So within that, stock that we like is Cyient, where the order and deal wins have been pretty strong. The delivery has been pretty strong. And in terms of earnings growth, for the next 2-3 years, we are seeing about 25-30% earnings growth to be delivered. And on back of that, valuations are still not that premium compared to what the growths are. So Cyient is something that we like within the tier 2, the engineering and development focused companies. We have a target of 2,400 on Cyient, which is a good decent upside from current levels.
Okay, so got it. Cyient in the mid caps, tier 2, and TCS in the large caps. Got that. Siddharth, thanks very much. Great having you on the show today. Have a good day, and we look forward to our next conversation.